Stephen's still here as well. He's joining me here on set. Starting in Venezuela, aren't you, Stephen? The government been trying to negotiate with its creditors.
It seems those efforts at least have partly failed. The ratings agency Standard & Poor's says that Venezuela is now in default after failing to make interest payments worth $200 million. The S&P has designated the country in selective default, which means it does expect it to make payments on some of its obligations in the future. Nevertheless, the agency believes there's a 1 in 2 chance of another default in the next 3 months. This news coming after Caracas held a meeting with investors on Monday. They'd been hoping to hear how Venezuela planned to avoid defaulting on a $60 billion bond. Instead, the vice president chose to blame the United States for its financial problems.
This assault has come from the US government as well as parts of the Venezuelan opposition. They have finished off with the few remaining ways that Venezuela still had to develop extensively within the international financial market. Today, Venezuela is limited in seeking finance from what has historically been our market, and we are finding ourselves with the need to propose new formulas to overcome this complexity.
Earlier we spoke to the journalist Anatoly Kurmaniev, who's in Caracas, and he says that investors didn't hear many concrete proposals at that meeting.
A few investors that bothered to turn up, they braved short notices, requirements for visas, a very dangerous, complicated city, Caracas, and they showed up here hoping to find out exactly how they're going to be repaid for their bonds and what is the government's plan to restructure. Instead, all they got was literally a box of chocolates. The vice president, who's actually on the US sanctions list, he railed against the US for half an hour, and then he gave a box of coffee and Venezuelan chocolates to each investor and let them go, and that's it for now.
Yeah, correspondent in Caracas. Is that news moving the markets, and Stephen?
No, because Venezuela isn't a country that's more enormously plugged into the international market. So at least for now, Venezuela not worrying investors too much. In Asia and trading today, the Nikkei finishing the day flat in Tokyo. We've got falls though in the Shanghai Composite. That's after some economic data out of China there came in worse than had been expected. On the currency markets, we're keeping an eye too on the value of the British pound, which fell in trading on Monday. That's over fears about Prime Minister Theresa May's future. Pretty flat today against the dollar and the euro, but no sign of any recovery either. The pound there trading for just over $1.31.
Now, here in France, workers at General Electric, that's formerly Alstom's energy business, they're worried about their future.
That's after GE announced that it was selling off assets worth $20 billion and cutting its dividend payments. This part of an overhaul being driven by the company's new CEO, who took over in August. Now, 2 years ago, GE bought Alstom's energy business, promising to create jobs in France. But now workers here are concerned that they could be affected by these changes. Robert Sutton-Mattox has more.
Alstom, lying in the shadow of its new owner, General Electric. Its energy branch was snapped up by the American giant in 2015, and it was targeted by its new CEO when he took over this summer, saying that its French subsidiary had fallen below expectations. But 2 years ago, General Electric said it would take on 1,000 new workers before the end of 2018, a promise that has proved difficult to keep. The group has already forecasted that within a month they would get rid of 345 posts at their site in Grenoble. With GE struggling, striking workers fear even bigger job losses are to come.
If tomorrow there is a reduction in the number of posts globally, we are certain we'll be the first to be hit. So this will add to the pressure that the site is already experiencing, that's for sure.
GE's French subsidiary isn't alone in facing an uncertain future. The group is going through a tough time. Its shares have lost 37% of their value since the start of the year, and thousands of job cuts are planned around the world.
A couple more of the day's business headlines for you. Shares in the toy maker Mattel jumped by 1/5 on Monday after reports that rival Hasbro is considering a takeover offer. Mattel, which is best known for its Barbie and Fisher-Price ranges, is estimated to be worth some $6 billion. In its most recent results, the firm reported a loss, though, after sales fell by 13%. And Credit Suisse has been fined $135 million by a New York regulator over violations of foreign exchange trading rules. The Department of Financial Services says traders at the Swiss lender engaged in improper, unsafe and unsound conduct for an 8-month period up to 2015. The DFS had previously fined BNP Paribas for similar offences.
And finally from Stephen, we just had the films, haven't we? But apparently Lord of the Rings could be reinvented yet again, this time for the small screen.
Amazon has won the rights to adapt J.R.R. Tolkien's trilogy of books for television. According to reports, the deal was worth close to $250 million. The adaptation will see new storylines preceding the Fellowship of the Ring, developed for Amazon's Prime streaming service. No details yet, though, on what writers or actors might be involved, but it will be another reinvention, as you say, of the books after the films that we know so well.
Enough is enough. Thank you very much, Stephen. Stephen with Business.